How's it going, everybody? My name is Antonio, and I'm back for some resource talks with Tom Luongo, who, of course, needs no introduction. He's the anarcho-capitalist, geopolitical expert. Too many labels. I'm not going to go through all of them. And he's also had the displeasure of talking to me multiple times before, so I'll just jump right into this. But not before you've understood that this conversation will be general and impersonal in nature, and it will include no financial nor professional advice of any sort. It will include, though, a lot of forward-looking statements and discussions about high-risk industries like uranium, gold, silver, and whatever other natural resources that we might come up with that you will lose money on if you don't know what you're doing. So pause the screen, read the warning. It's not just some disclaimer. So you got to have to wear your big boy panties and make your own decisions. That's what it comes down to. So that all said, Tom, you're enjoying your coffee. Thank you for investing your time with me, sir.
Thank you, Antonio. It's been good to talk to you again.
Pleasure's all mine, of course. It's been what has it been, about 8 months or so since we last spoke. So it's actually when I trying to prep for these interviews by watching previous interviews, and I was going through some of the predictions that you told me, and a whole lot of the things that you told me back then. The main takeaways was that basically you told me that the Fed put was dead, and that inflation will stay high, and that the markets will remain far more resilient than everybody thought they would for longer. While also you told me that the Fed would keep hiking. You were calling for 6-7% federal funds rate because of ongoing currency war, putting pressure on the dollar, and just like, of course, inflation also is, and so on and so forth. But pretty much that's been the environment. That's pretty much all that has happened in H1. So, well, congratulations, first of all, I guess. And second, was that still the outlook? I mean, are you still behind those things?
Yeah. I mean, for the most part, I think we're just in exactly the kind of inflationary lull that we expected. Right. When you go back over what we had in terms of inflation from 2021 and 2022, it was mostly driven by commodity prices and rent and a variety of other things. Right. That's where most of the inflation was. It's certainly, I think Zero Hedge did a great article going over it back in May, where they said, look, 65%, or no, it was about the May CPI number. So that would have been an article from July. They said, look, up so far, you could strip out gasoline prices, and that would account for about 65% of the measured inflation in CPI. I said, well, gasoline prices are down. And when you chart wholesale gasoline prices 6 months out of phase with the CPI, they kind of overlay on each other since COVID really, really well. Before COVID, no, it's a random walk. Like gasoline prices and the CPI were not correlated. So it was a different kind of inflation back then than it is today. And I've been arguing that this is a commodity cost push inflation, not demand pull credit inflation, based inflation, where demand is pulling the demand for money higher and prices higher. And therefore the Fed's got to throw credit into the system in order to generate enough liquidity in order for the economy to hum at the rate that it wants to hum. Right. And that, of course, in a fiat-based system is going to be based on the interest rate and, the capacity of the economy to service said debt. What we have post-COVID is commodity cost push inflation with the disruption of supply chains. So this is a much easier inflation to understand, and therefore it was tied to the rising price of base commodities. This is not a type of inflation that the Fed is designed to combat. It's designed to adjust the levers of credit. It's a demand. The Fed is a Keynesian institution. It's a demand pull organized institution. It cannot deal with commodity cost push inflation. So from the beginning of this entire rate hike cycle, what I've been saying is, well, then why does Powell want to raise rates? Well, it can't just be to tame inflation. That has to be the cover story for the Keynesian cover story. But the reality is that he was trying to drain the excess credit from the markets, overseas and domestic. And he's done that brilliantly, while inflation would take care of itself. So in June and July, the worst of the year-over-year or month-over-month inflation effects were in June of 2022 and July of 2022, where the CPI rose 1.0 and 1.3%. In those months. So when we got to June and July's CPI this year, and they only rose 0.3, 0.2, or whatever they were, around 0.3% each, inflation rapidly came down from 5% to 3%, and that's where we are today. But none of that has to do with credit. very little of that inflation coming down is because of the lack of access to credit, because there's still too many dollars sloshing around. They haven't been serviced, and and the debt hasn't been discharged, and yada yada yada. And there's plenty of liquidity within the U.S. banking system, because there was $2.5 trillion worth of money sitting in the reverse repo facility. There's $5+ trillion worth of U.S. Treasury sitting on the Fed's balance sheet. Not anymore. It's a lot less than that now, because they've been getting rid of them at $95 billion a month or so. So the Fed had both liquidity to dump into the system if necessary, so we can keep liquidity high, meaning there wouldn't be a credit crisis, right? And there may be deteriorating credit conditions. There may be a slowdown in spending. There may be a whole lot of things happening, and that may imply that there's going to be, a problem in the future. But as of right now, no. And once you get commodity prices bottoming, and you look at the fundamental supply and demand mismatch and the geopolitical war over the price of oil, pretty clear that we've been in a supply deficit for oil that was only made up by discharges from the Strategic Petroleum Reserve here in the U.S. by the Biden administration to drive the price of oil down. Once that stopped and Biden has to refill the SPR, which he refuses to do, by the way, and the Saudis and the Russians keep cutting production, well, we're where we are today. Goldman, I think, came out the other day and said we have a 3 million barrel per day supply deficit in the oil markets. Myself, Anas Al-Haji, and other oil analysts have been sitting there going, we're in a supply and demand deficit. And no global recession that's over the horizon is going to stop that, because the demand for oil at this point is still relatively inelastic. Even the IEA had to come out recently and say, look, we're at record oil demand. Okay. And so one of the other things I noted, and as this was going on, since the last time you and I spoke, I kept looking at data to try and looking at moments to see if my thesis that oil would start to rise in the second half of this year, which I made that prediction at the beginning of the year, that low 70s would be the bottom for oil, and that we would start to see a return of inflation in the second half of the year. Well, go look at the U.S. oil numbers. Production is flat. Why? The Baker Hughes rig count is down 30% since the beginning of the year, 25-30% since the beginning of the year. So oil production is flat overall. Imports are up and exports are down. The Russians are exporting less oil because they're producing less. The Saudis are exporting less oil because they're doing production cuts. Yes, Iran has come back into the market, but that's all going to China. Well, what about everybody else that needs oil? I don't see India's not in a recession. I don't see, and Europe still needs oil, and they're still, importing large amounts of oil into Rotterdam every day. It's not like they're not doing it. They may not be buying it directly from the Russians. They may have to buy it from a Bahamian reblender and then send it back to Rotterdam. And it's 20% American oil and 80% Russian oil, or whatever it is. But it's the same. But it's still oil. So that is the big story, which is that we're going to have a second round of commodity cost push inflation. It's hitting now. It's just starting. It's going to show up in the retail. It's showing up in the futures price of gasoline. I've noted the other day that I think that there's some, flow, a breakout level about $2.85 a gallon wholesale price of gasoline. If you look at a chart if you just look at a weekly, daily chart of the price of gasoline, and there's been just some weird moments where it closes at this number on Friday and then opens 30% down, 30 cents down on the Monday open, and there was no news. There was just, hey, we're going to open the market 30 cents down. Like, what the hell is that all about, right? When you live in this world, Antonio, and you see the kind of manipulations that you see in markets every day in order to try and keep these price ranges that we're in stable, and they're all very metastable, it becomes very obvious that certain players are constantly trying to move markets in a particular direction in order to support an agenda. The problem is that eventually you will run out of time.
But did you see what happened actually today? Because we're now on the topic of oil, where President Biden issued an announcement. He was on Twitter saying, "My administration," and I'm quoting, "My administration is canceling all remaining oil and gas leases issued under the last administration in the Arctic Refuge and proposing to protect 13 million acres in the Western Arctic. There's more to do, but we're taking action to meet the moment for future generations," unquote.
Yep. No, Biden clearly works for the climate change agenda emanating out of Europe, because guess what? We need to shut down oil production around the world, and make the world safe for climate change, and make everybody else's life energy unstable because they don't have any energy. The people who are generally pushing the hardest for climate change are the people who don't produce hydrocarbons. The carbon they want to reduce is you, because they don't produce any.
Yeah.
Okay?
Yeah.
Europe is it's just that simple. It's Europe has no hydrocarbons, so therefore the rest of the world can't have hydrocarbons. It's not really that difficult, guys. It's really not. Just understand that these are the same people who think they've run the world for the last 400 years. The old European colonialists, be they British or Dutch or Italian or French or German or whomever, and they are who they are, right? That's, they just don't want to give that up. And that's what we're fighting here. We're fighting this civilizational clash between people who want to remove physical collateral from the monetary system and remove oil. And by doing that, they remove oil as the center of the energy we burn, in order to fund a shame and credit-based system, with no physical collateral underneath it. And that way they can just track us and shame us and tell us that we can't have nice things like, air conditioning and, showers and hot water, because, we don't deserve it because we're ants. And that's the way they think of us. And that's the way you have to understand the way the policy has been crafted. And once you understand that, it should, one, make your blood boil. And then two, you now know who the enemy is. And Biden works for the enemy. Everything he does, everything Obama does is a shadow government. Everything that Anthony Blinken does, everything that Hillary Clinton does, everything every one of these freaking people does is in service of this agenda. And this agenda is fundamentally anti-human.
I don't want to,
because oil is the one thing that ultimately has liberated more people around this planet over the last 200 years than any other substance in history.
Yeah.
In history. So that's why it's so important that they take it away from us.
I know, and it's getting too obvious, and it's reminding me. I don't want to turn this into a political podcast, but it is reminding me of a meme that I recently saw, where it's like the American flag, and it says "work or starve," and then there's the communist flag, and it says "work and starve." And it's a really funny meme, because it's true. It's actually not that funny if you go 100 and some years back in Europe. So.
I know that you don't want to go into that realm, but the problem is that all of these markets are highly politicized. See, the reason why you opened this by saying congratulations, you were right about everything. I'm like, well, no, thank you. That's not what this is about. I mean, I want to be right because I want to give people good information, good actionable information. It's not about feeding my ego. That's already gets plenty of help on its own. What's important here is that once you can see what the incentives and the incentive structure are of the people setting the policies, then and then predicting what's going to happen next is really kind of easy, because the politics and the agenda behind the politics is what's driving the prices in the marketplace. It's what's driving the downstream effects. Okay. We don't have I'm getting to the point, Antonio, where I want to believe that we don't even have real capital markets anymore, but capital markets are trying to reassert themselves as real things in a world of fake money, in a world of fake politics, in a world of fake ideology and fake everything. This Scott Adams constantly goes on, do we live in a simulation? Well, yes and no, Scott. We don't live in a simulation. We don't live in the Matrix, but they want us to believe that we do, when we really don't. They want us to believe we don't need to have a monetary system that is not built on physical collateral, oil, gas, labor, this, that, land, whatever, right? Productive capacity of the people that that are the political entity that issues the currency, however you want to describe that. But they want that, but it's not feasible. It doesn't work, and we need to stop even giving them any, give them the time of day. You realize that the whole system is designed around carbon credits, that they want to replace. They want carbon credits to be the new reserves of the banking system, right? That's what they want. And what are carbon credits? Well, that's your debt that you owe to the society for actually being alive and breathing and aggregating carbon to yourself from the 8-pound thing you come out of your mother's womb I'm sorry, birthing person's womb and into the 200-pound person you are later on. You owe that debt to the world. Because eventually you're going to die and you're going to put all that carbon back into the universe. And that's bad because carbon is evil. Like, are you kidding with this nonsense? I'm literally trying to tell you that your existence is evil. So again, I know that's not necessarily where you want to go with this conversation, but it needs to be stated at the outset so that when we sit down and talk about gold and silver and oil and uranium and everything else, we can understand the context about why these markets exist, operate the way they do, why the bond markets are so terminally screwed up, and why the Fed is breaking these people so fast it's not even funny. Because once you understand those relationships, then you understand that this was the easiest thing to beat them with, which is you control the value of the dollar, to control the price of the dollar, and everything else falls in line very quickly.
Well, but that makes me think about targets, though, like R star or the inflation target of the Fed and how the market looks at those. And do you believe that the neutral interest rate, that's what it is, so R star, the neutral interest rate, and the inflation target, do you believe they should be just generally higher in a functioning market than 1 or 0 or whatever they have been?
I don't. Yes. Well, R star should never. We should never consider the idea that R star should be 0. R star at 0 means that money is free because it has no opportunity cost associated with the generation of new units thereof. Right. That's what R star equals 0 means. That means infinite money. It means infinite money because it means 0 risk of losing capital because you can buy as much of it as you want, and you're maximizing the amount of risk you're willing to take on rises asymptotically towards infinity in an R star equals 0 situation. Like this, it's always to your best interest is to borrow more, even if you lost more, because you're never paying back interest on the money. And then if you go to negative interest rates, well, then you cross the asymptote into stupid land. Like it's just at that point that's clown world, right? Because that's like, and I almost made a particle in the box, like quantum tunneling argument. I'm like, yeah, no, that's not that metaphor is not going to work, and it's going to go over everybody's head. But no, it's silly. You want to raise R star, and you want R star to be. And look, the Fed doesn't know what R star is any more than you or I know. This is the fundamental Austrian critique of central banking, or Austro-libertarian critique of central banking, right? And from
what do you think it is, though?
I don't know what it is. It's whatever the market should demand it is. And I think in this environment, it's probably closer to 6% than it is 2%. And the inflation target is not, and 2% inflation is stealing all your wealth in 36 years. Rule of 72. Your wealth compounds, it doubles in 36 years. Under the rule, I think that math is right. They're stealing your wealth, their real wealth, through a 2% inflation target. Inflation should be structurally negative. We should always be operating under a structurally deflationary environment, because technology drops the cost of production. The Fed is trying to keep the amount of money, just trying to keep deflation from happening, because deflation is bad for banks that then have to do accurate risk assessment on what they should invest in. Whereas our purchasing power should rise over the course of time. Our savings should rise in purchasing power if technology is moving the value of our savings forward. So this is the classic Keynesian / monetarist argument. Well, if that's the case, well, people will never stop saving because it's never in their best. Yeah, but people have to eat. You can't eat your savings. You can't eat gold. So you're always going to be moving money back into the system. You're always going to be, you're just not going to, and no one's saying that, they might want their wealth to compound at 0.5% of deflation every year is enough for them. I mean, they may need more, they may need 4%. Therefore, they're going to go out in the market. And at some point, someone's going to offer you a high enough rate of return on your savings, which is appreciating, say, at 0.5% a year in deflation. They're going to offer you a thing that's going to, give you 6%. You may make that that bet with 5% of your saved capital. I mean, these arguments that I've argued with monetarists and I've argued with Keynesians about this, and they are so scared of deflation. It's unbelievable. Whereas, no, deflation is how the middle class builds wealth over time. It's how the oligarch class steals wealth over time. The only interest they should earn is that on making the right bets on investments into new technologies, because it's eventually, once the technologies that exist push down the depreciation curve towards their cost of goods sold, there's no more deflation. There's no more. That's the moment when people are like, okay, I need to deploy capital in order to improve my life, because your life is not going to improve at that point. And we act in order to improve our future. We act in order to improve the predictability of our future. That's why we act as humans. Okay. We don't necessarily think about that every time we do something, but we generally make decisions that are accretive to our personal view of our own stability, that makes us happy. Be it either, in the short term, eating a candy bar, which makes us happy, to building a house, which gives us a roof over our head, which makes us happy because we're now, mostly free from the weather. Unless you live in Florida and, there are hurricanes, and then you got to build a stronger house. Right. But understand, but that's why we do what we do. And I these are like the way we view money and the way we view inflation versus deflation, and everything else is all, it's like you have to deprogram people from the Marxism and the Keynesianism and the monetarism, which is all just basically Marxism. Like, you got to redefine the freaking terms before we can even have a rational conversation about what we should be doing. Like, our entire system is designed to extract the wealth from the people and roll it up into the overclass, which then dictates to us what we are and are not allowed to have. And I fundamentally disagree with that. Like, fundamentally. And I think everybody listening to my voice would go, yeah, that seems dumb. Like, why would anybody even cheer for this system? Even if you do believe that we have to give some money, that taxes are the price we have to pay for civilization, or whatever bromide you tell yourself in order to get to sleep at night, while you live under tyranny. That's great. But I don't care. Like, I'm not, that's between you and, that's between you, your wife, your bed sheets, and whatever deity you pray to. I don't care. But for me, like, just philosophically, why would anybody go along with this other than the people, of course, who want to be the oligarchs? And then what do they tell you? What do they bamboozle you with in order to rob you of your reason? Nonsense. Literal economic gobbledygook, like the labor theory of value, Keynes's general theory, Milton Friedman telling us that it was the Fed. It was the Fed caused the recession, that caused the Great Depression, when it wasn't. It was, it was capital inflow in the 20s, and a sovereign debt crisis in Europe, which sent stock markets rising, and then the money flowed out again, and the Fed had nothing to do with it. Like, it's all nonsense. Like, these people are all just liars, dude. I think they literally are. And then we're supposed to sit here and argue about the quality of their lies. So I'm at the point now where I don't even want to have those conversations. What I want to have are the conversations. You touched on the right subject, which is, what should the risk-free rate be? What should inflation look like? It should be deflationary, not inflationary. If our governments worked for the people like they're supposed to, but we're the only country that actually does it. Everybody else is the government's sovereign, and the people are slaves. Go read your constitutions. Like, that's why they hate the United States so much, these people, because we still have this structure where the people are, that the government is subordinate to the people in theory. In reality, it's obviously not the case.
And what happens during inflationary times is that, why would you save money when, it's going to be gone in how many ever years? And that's where we're seeing the personal savings rate is now, going below 3.5% of the DPI, disposable personal income, which is to say it is very low. That would average between 10% and 12% from the 50s, almost, through the 70s, almost into the 80s, it averaged. And then it started terminal decline at like the 80s, and then it went as low as 2%, which is crazy in 2005, and so on and so forth. So this is what Rick Roll tells me often, is that this is a war of spenders to savers.
Yes, absolutely. Rick is absolutely right about that. Completely correct. That's Rick has, comes at these things differently than I do. I haven't listened to Rick talk in years, but I remember him talking about these things when I used to listen to him before I started doing basically the talk show circuit. Right. Rick is absolutely correct about this, that this is spenders versus savers. And the Fed is always at war with savers.
Yeah.
And one of the charts that I've published multiple times over the years to try and remind people about why the Fed's not going to pivot. I'll give you a perfect example of why the Fed's not going to pivot and lower interest rates. Ready? Personal savings rates 3.5%. The start and stop of every round of QE is tied to the personal savings rate getting above 7.5%. They are just Keynesians, and they do believe in the paradox of thrift. So they believe that a savings rate that is too high is detrimental to the economy, and therefore we have to punish savers and push that money back into the marketplace. And so you can look at the personal savings rate of the United States. Now they restate it every few years, so you have to kind of like every once in a while they go back and they reindex the damn thing. So it's so freaking annoying. I've got the 20-year chart of the personal savings rate, and like markers of QE1 starts, QE1 ends, QE2 starts, and it's all tied to once the Fed gets the inflation rate, gets the savings rate, and they're comfortable that it's below 4% or 5%, then they end QE. And then once it starts, and once people start getting antsy about the future and the savings rate starts to rise, QE. This is what Bernanke and Yellen did, and even Powell had to do this, but during COVID. But during that period of time, look, the personal savings rate during COVID shot to 33% because people just weren't spending any money because they were locked in their homes.
Yeah, and
so now all that savings has been spent, and that's where we are right now.
Right, and so here's what also happened to sort of complement that is that most of the 2022 and 2023 growth so far, if you can call it growth, that I've seen in the U.S. as far as I understand it, was due to credit expansion, which for 2022 was about 3 times that of 2021. And then the reason for that was that maybe consumers saw interest rates going higher, rushed to get loans and get lower rates. And then they also, they also started spending all that money that had come in through stimulus checks and all that had gotten that savings rate up to 34%. But if our star is higher and the Fed will keep hiking while it also keeps tightening as it has, with domestic liquidity in the U.S. has now been flat for over a year now, and now that's also on the back of the broad money supply being in a downward trend.
Yep.
I'm just thinking when does this run? Is it running out of fumes right now? Does it run out? When are we going to have enough credit expansion to keep the economy growing? Those are sort of the things that I think about.
I don't think I don't think anybody's like you should not be under the impression that I'm arguing that there's not going to be a recession. That nominal spending is not going to fall. Remember, gross domestic product is gross domestic spending. Don't forget that. That's all it is. All they do is add up all the spending and then call that output. It's just dumb. Doesn't say anything about the quality of the spending. Doesn't say anything about whether we bought hookers and blow and subscriptions to OnlyFans and or did we buy new oil refineries and whatever else, and new technologies. No, mostly we're just buying OnlyFans subscriptions and sitting around waiting for Armageddon. So gross national spending is what nominal GDP is what it measures, nothing more. Okay, I don't fear a loss of spending. I don't fear a recession in spending, because what that means is people are being prudent and thinking hard about what they spend their money on. And when there's a contraction in spending, yes, it's bad for the banks. Yes, it's bad for this. Yes, it's bad. Blah, blah, all that. Yeah, I agree. And that means that some people have to, buckle up. Who's going to buckle up? Who's going to have to buckle up? It's not just the lower classes. This time it's going to be the actual banking sector. And that's already happening. And this is, and I think that at this point, with there being no balance sheet room left for the entire United States, that given the choice of the banks having to take a haircut on this one and the people, as opposed to just the people, and when we bail out the banks, which is what Bernanke and Yellen did, notice so far that Powell hasn't bailed anybody out. He hasn't bailed out private equity. Hasn't bailed out the banks. He executed some really bad banks and then absorbed their good capital into a bunch of New York banks, right? He executed a bunch of San Francisco banks that fed anti-American freaking Davosian oligarchs. Silicon Valley, Signature, all four of those banks were all Janet Yellen allowed Frankenstein monstrosities buying DAs and congressmen and assemblymen all across America, and judges and all this bad stuff that we see in the culture war. Well, guess what? That was all bought and paid for with funny money that went overseas after we sold the treasury and then brought back to us, levered up 20 times through the crypto markets, and then filtered back into the real economy and used to literally open the border and destroy the country. Like it's insane. It's so very clear. And we see, and I called this when these guys were getting executed. I called it when FTX got executed. I said the Fed executed FTX on election night to send a message. Then in March, they executed 4 banks in a week and saved you, and then saved Credit Suisse without telling the ECB and the European Union about it. They just cut a deal with the SNB and UBS and wrote down all the AT1 cocoa bonds and literally told George Soros, go, you lose, sir, you get nothing. I'm trying to keep it clean this morning.
Well, so, a couple of days ago, you go ahead.
So understand, I'm like jumping around here, but understand that this is what we're dealing with. We're dealing with an actual honest to God war at the top of the banking system, because we're dealing with the real civilizational war here isn't just, as my friend Alex Craner likes to put it, it's that Soros model of 2 systems of governance. It's really about the private versus public formation of capital. Are we going to have a commercial banking system that does risk assessment and skims a profit off of the advancement of society, which is what it's supposed to do? Bank lends you money at 6%. They get 3. The savings holders get 3. Everybody's fat and happy. The bank grows. The savers grow. Everybody wins, and the society benefits from the successful investment into this new technology or this bridge or this library or whatever it is that we built, this hospital, yada, yada, yada. Or are we going to have the government do it for us? Davos wants the government to do it. Davos wants control of the money, wants it based on carbon credits, wants to be able to shame you and say, nope, you're not allowed to own it. You're not allowed to buy a pizza because you're fat. Your blood pressure's too high. Pizza's disgusting. You should eat broccoli. This is Christine Lagarde's words, people. Okay. This is the world they want us to live in. And they want to be able to change the rules at a moment's notice without any input from the electorate on the EU Commission, EU Politburo model. Because it's the EU SSR, it's not the EU. The EU needs to die. And it needs to die tomorrow. And as far as I'm concerned, if Powell needs to raise rates to 7% to beat these people, raise rates to 7%, we'll deal with the fallout here. Yeah, there's some banks will fail. Yes, some people will there'll probably be some debt jubilee and a whole bunch of credit crisis and all the rest of it, but you will create a smoking ruin that was the European Union, and the liberation of Europe can commence. And that's what needs to happen. And evil people like Emmanuel Macron and Christine Lagarde and Annalena Baerbock in Germany and Tony Blair in Britain and all the rest of they all go hang. These paper hanging awful people. This is what has to happen. There would be an explosion of immense human ingenuity if we could just get these friggin' people out of our way. And I believe fundamentally that Wall Street understands that that's the existential threat, and they're willing to cut a deal with us over it. Because otherwise, they lose everything. Because Klaus Schwab or whoever it is that's behind Klaus Schwab wins, and we go through a period of public formation of capital until we, and then we go through an entire generational cycle of that. And we look like the Russians in 1917. Okay? Because that's what we're dealing with. That's the precipice we stand on. And we can have the central bank reformed back to its original model, as Martin Armstrong has been banging on about for years. Like, look, get the Fed back to its original mandate. It's not good, but it's still better than what we currently have. Get it back to, regional interest rates, only providing short-term, lender of last resort facilities to the banking system. Stop trying to manage employment, stop trying to do all of this other stuff that the Fed tries to do. Get back to what the Fed was designed to do. And while that's still not good from an Austro-libertarian perspective, it's 100 times better than what we currently have now. So I'm all for rolling the Fed's power back in stages. And then I'll fight the fight of getting rid of the regionalized Fed, in my Social Security years. But let's get through the next 10 years where we don't wind up with the ECB model, where it's all nebulous and it doesn't matter. And whatever they say tomorrow can be, turned around and negated the day after. Because literally that's how they run the EU. They change the friggin' diktats every day. It's like living in Brazil. Terry Gilliam's movie Brazil. It's obvious. So
yeah, I'm in this discussion. I'm constantly reminded of a couple of memes, and this is sort of the meme where, that one guy that's cycling and then he puts something in his wheel and it's, oh, why is the economy so bad? It's the same with housing. Actually, I'm reminded of housing and all the time throughout this.
I always say it as I always say it as, damn it, Putin.
Yeah,
it's like, damn it, Putin.
Yeah, exactly. Well, that thing, but same thing with housing. I mean, housing staying expensive. We are in an intergenerational potentially housing boom because there's not enough supply. It seems out there, and so you last time we spoke, you told me that sort of your base case expectation was recession 2024, rate cuts in 2025 or late 2024. Where's that recession going to come from if we have a strong labor market and a strong housing?
I don't think we're having a strong labor market. I think the labor market is more resilient because remember, there's more liquidity. We still have $1.5 trillion worth of RRP balance that needs to be pushed back into the money markets, and then it's being pushed back into the money markets at 5.5%. That provides an awful lot of liquidity to the banking system and to the credit markets. And like people can get 5.5% on a 3-month T-bill.
Well, but is it because liquidity is flat, right? On a over a year.
Liquidity is flat, but it's not crashing. It should be crashing in this environment, right? It should be crashing, but it's not. It's not crashing because again, you can take the money out of the RRP facility and put it in the treasury market and get a couple of basis points of the yield. And that's why it's important to look at the short end of the yield curve. Like the short end of the yield curve is now normal out to 6 months. And Janet Yellen is working overtime to keep it from normalizing out to 1 and 2 years. And the 6-month 1 year spread, I don't know if you've followed me on this one because you probably haven't, but for my patrons, I publish on a regular basis. I do a market report every Wednesday and every Sunday. And in there, I update what's happening within the U.S. yield curve because now it's all about the normalization of the U.S. yield curve. And I really think that that's what's happening, that the U.S. yield curve is going to begin to normalize. Okay. And it is normalizing if you watch it. So break the entire yield curve down by each successive maturity spread. So the 1 month, 2 month spread, the 2 month, 3 month spread, the 3-6, the 6 1 year, the 1 year, 2 year, and then break it out. And you can watch how those spreads are tightening. The inversions are lessening. And I've got a time series. I've been charting this since the beginning of April, I think. But And I just set an arbitrary date because I publish this on Wednesday, that every Wednesday we look at the Wednesday close and you can see it. And, once the debt ceiling crisis was dealt with, the yield curve normalized very quickly out to 6 months. So it's rising out to 6 months. And then there's I think we're trading at about -8 basis points now between the 6 month and 1 year. It was as low as 20. It's now to 8 or 7. The 1 year, 2 year spread, Yellen continues to work to help Christine Lagarde do yield curve control in Europe by manipulating the 2-10 spread here in the United States, the 2 year, 10-year spread, which is very important for mortgage rates and all of that. So the 2-10 spread is kind of the big thing, right? And it's now still -70 basis points. Was -110 basis points. Oh, by the way, but now it's down to the -70, high 60s. And every time it seems to get into the 60s, that's when Lagarde seems to get into trouble, and then Yellen has to bomb the markets and sell a whole bunch of 2 years or whatever she does. And she does a whole lot of this. Remember, she still has the president's working group on financial markets, otherwise known as the plunge protection team, to play around with things. Never forget that. But she also manipulates things by using the Japanese bond markets and a variety of other stuff. So But they're all running out of room because the yen is trading at 148, and the BOJ is going to have to intervene at 150 at some point. They're going to have to let the 10-year Japanese bond go above 1% because otherwise they're going to have a revolt in Japan. And Ueda at the BOJ understands this, so he's trying to normalize the Japanese yield curve by degrees. But every time he does that, he's forcing the unwind of carry trades between Japanese, American, and European debt. And Lagarde is absolutely trying to cap the prices of all the 10-year European sovereign debt. The German 10-year 2.5%, the French 10-year at 3%, the Italian at 4.25%, the Spanish at 3.7%. I published all this before, and it's mostly. And every time she intervenes in the market and gets help from Yellen or whomever, the amount of effect she's having is less and less and less. It's like heroin, right? It really is like financial heroin. You do an intervention, it suppresses German bond yields for 6 weeks. The next time you do it, it suppresses for 5 weeks. The time after that, 4 weeks, then 2 weeks, then it's 2 days, then it's 24 hours. Now it's, we'll move the limit up to 2.65%, which is where Lagarde is today. Okay? We're in September. One of the talking points I've got for you is we're in that period between Labor Day and the beginning of Q4. What happens between Labor Day and Q4? All the pros come back from their summer vacation in the Hamptons. As my friend and partner in Gold, Goats, and Guns, Dexter White puts it, oh, by the way, folks, the Hamptons still matter. Okay? Meaning that the Jordan Belfort types, the guys with the stiff white collars and the blue striped shirts, they go back to their trading desk after kind of just, screwing around all summer. And that's when they get serious. And they're now looking at their quote screens. They're looking at their funds. They're looking at their positions, and they're going, yep, Q4 is in 20 days. We've got taxes we got to deal with. We've got management strategies. And what are we looking at for 2024? Why is the first week in October always seems to be Black Monday? It's because that's the day. That's usually the first trading day after the end of Q3 where everybody goes, time for a new strategy. And then the markets take it up. I think we're going to see the return of the bond vigilantes to the sovereign debt markets that we've not seen in a generation or more. Okay. Why have the bond vigilantes never shown up like Milton Friedman told us they would? Why not? Because Bernanke and Yellen kept killing them, executing them by every time pivoting before they were supposed to push back to the zero bound, feeding the Eurodollar markets, feeding City of London, feeding Hong Kong, feeding Singapore, feeding Zurich, keeping their banking systems alive and crushing us. What if Powell doesn't pivot? What if Powell finally has their attention and they finally they're over their PTSD of Greenspan, Bernanke, and Yellen, and Powell sitting there going, oh no, guys, come on in. The water's warm. We turned the heaters back on and we got the jets running. It's cool. It's awesome in here now. You guys can play to your heart's content. Oh, by the way, break her. Break Europe. Break Germany. Why? Because that's the only way Wall Street survives. And if you don't think that those guys are sitting in planning meetings right now with their VPs, and the VPs are not sitting with the CEOs at the major money center banks in New York, who already started this process in the first place, giving Powell the green light to go to 5.5%. You don't think that that's what's going on next? Because I'll tell you right now, if I were Jamie Dimon, this is exactly what I would be telling my VPs. Like the guy who runs the bond desk over at JP Morgan, I'd have him in. I'd be like, what are your traders doing this year? Well, clearly we should be short Europe and, long the dollar. I'm like, yes.
But they're shorting bonds. I mean, isn't that what the bond vigilantes are supposed to do? Push rates higher. 10 years, exactly. 15-year high.
That's what I mean is what's going to happen. And it's going to blow all of these yield curve control schemes of Yellen and Lagarde out the window. And the big tell here was that the Bank of Japan in the switchover from Kuroda to Ueda began with Kuroda last December moving the yield curve control target from 0.25% up to 0.5% at its last meeting, walking out the door, and Kuroda's right-hand man stepping aside and saying, I'm not the right guy for the job. I've been here during all of the yield curve control in the QE years, and it's clearly not the right environment. This is Japan, in which seniority matters in a way that we Americans do not understand. To have that guy step aside for, quote unquote, the good of Japan was your major tell that the Bank of Japan was done with this and was going to have to raise rates, and has done so. And so Ueda has been very, very careful in how he's done this, but now he is keeping the entire market. For the first time in 30 years, we don't know what the Bank of Japan is going to do next. I've likened it to a game of Texas Hold'em where the Fed underplays the power of the hand that they have, and they play dumb, and they never play position, and they never play their aces like their aces. Because of that, everybody jumps into the pot. The ECB gets to deal off the bottom of the deck in order to always hit their flush or always hit their straight draw. And the Bank of Japan plays with their hold cards face up. They just turn their hold cards face down. And now people don't know when they're going to intervene. Oh, well, we may intervene between 0.5% and 1%. And the bond vigilantes immediately came in and tested them. And the Japanese 10-year moved from 46 basis points to 60 basis points in an hour. And the Bank of Japan came in. They can't afford to allow the yen to depreciate that far, especially with oil prices rising. We're going back right to the beginning of our conversation. Oil prices are rising. It's putting downward pressure on energy importing currencies, the euro and the Japanese yen. So the central bank policy has to change. Lagarde is at 3.5% or 3.25% because she had no other choice. She didn't want to leave the zero bound. She wanted to do QE to infinity.
Of course. Of course.
But she's having to do so because and what she was allowed to do was to get away with all of this because they capped energy prices and drove the price of oil back down into the low 70s. It was an operation. They released stuff from the SPR. They vol washed all the small specs out of the Brent crude market. They redefined the Brent crude contract by adding 25% weighting of WTI into Brent crude 4 months ago to try and keep oil down in the 70s. And now it's back to $90 a barrel Brent and on its way to 110 because the Saudis and the Russians kept going, that's nice, we'll cut production. That's nice, we'll cut production. And the production cuts that they announced at the beginning earlier of the year are now starting to hit the market. And now we're at a 3 million barrel per day deficit, and everybody knows it. And it doesn't matter if there's a global recession. The global recession is going to take what? 1 million barrels a day worth of demand off the market? Maybe. The demand for oil is mostly inelastic. So all the Russians and the Saudis have to do is slow down the pumps. And they can keep the market balanced wherever they want it. Now that they're into that, now that they've started the process of shutting down extraneous production. And the Americans are capped. And Biden is now refusing to do any more. Now, at $90 a barrel, the shale drillers are going to start going into the marketplace. But here's the problem. They can't go in and get 2% loans. They need to go and get loans at 8% because the Feds are at 5%. The Fed is at 5.5%. So now the question is, where's the money going to flow? Is it going to flow into BlackRock, buying up, everybody, trying to bankrupt everybody's houses and buy up their homes and apartment blocks? Or is it going to go to oil drillers out in the back end of the Permian where it belongs? Because what can actually produce an 8% return on investment, a 9% return on investment? Oil at $90 a barrel can. So again, it's a reorganization of where capital is going to flow. And it's taking power away from the BlackRocks and State Streets and the Vanguards and all these other people that have become the boogeyman. And that's why BlackRock is ending ESG. That's why BlackRock is desperately sitting there, like now bargaining with the Fed. I remember 2 years ago, Antonio, getting unbelievably obnoxious pushback from hardcore Fed hating guys on Twitter telling me that I was wrong and that they made fun of me when Powell only raised a quarter point to 5%. Oh, look, you're wrong. I'm like, and blah, 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 blah. And I'm like, yeah, okay. Oil's coming back. You're wrong about all this. He doesn't even have to go to 5% to win. Doesn't matter. I picked 6% out of my ass just to shock everybody. Just to get everybody to go, what in the hell is he talking about? Because everybody's like, the Fed's going to get the 1% and pivot. I'm like, no, he's not. He's going to get a 6. What? You're nuts. I'm like, and none of them could see what I could see, which is that they had, there's a downside to QE if you're a central planner and a non-central planner gets control of the money that you stockpiled in QE. It's that he can release that money back into the environment, which is what he did. The first thing he did was he drained the liquidity from the overseas market, and now he's deploying it in the domestic markets.
But you also have Yellen, though, and you have the Treasury. That's when I say Yellen, that's what I'm talking about. Mm-hmm. And they did T-bills last year. What if they go for longer duration and start sucking up liquidity out of the market that way this time around?
They could, but who's gonna buy a US 10-year at 4.25%?
A couple of people come to mind that have been bullish on TLT for the last 2 years. So but I'd rather not mention names.
Because I think they should be long TBT, not T. I think the normalization of the yield curve is going to be the big one. Like, here's the big question, and this is the thing I want everybody to think about. And again, I may be wrong, but hey, let's throw it out there. Another talking point that I've been curating recently. The American debt markets are still the central debt markets in the world. No, the USTs are still king. They're still money good everywhere. They're still safe haven assets. Are German bunds? The market is pricing the German bund as if Germany is a developed economy, a first world, safe haven, well-run economy. And that's why the German yield curve is inverted, just like the American yield curve is. People are saying to themselves, I don't believe between now and, I don't know, now and 2 years from now, that the central bank will be at high enough interest rates that if I forego the 40 or 50 basis points between buying a 1 year versus buying a 2 year, or a 6 month or 3 month versus a 2 year, right? You can buy a German, for argument's sake, you can buy a German 2 year for a German 3 month for 3%. You can buy a German 2 year for 2.5%. I don't know what those numbers are, but you're foregoing the 50 basis points over 2 years to say within 2 years, I'm going to make 20% on the price rise in the bond, which is why the yield curve inverts, right? The yield curve inverts because bond investors are betting that the central bank is going to lower interest rates, and they're going to make more money on the back end of the trade when they go to sell the bond at a higher price than the interest that they gave up for buying the shorter duration bond at the higher interest rate. That's the way you play a developed market, right? Sure. You play a developed market that way. How do you play an emerging market? How do you buy Vietnamese debt or, I don't know, Bangladeshi debt? When Bangladesh gets in trouble, you just across the yield curve, or Turkish debt, you just goddamn demand 30% on your bond to give them any money. Their yield curve inversion is irrelevant, dude, at that point. It's completely irrelevant. You just want your risk priced because you don't have any faith in the central bank because the central bank has no control over things. My argument is that in Q4, the bond vigilantes here in the United States and the developed markets around the world are going to begin to finally look at Europe as an emerging or frontier market as opposed to a developed market. they're going to look at Germany the same way they used to look at the pigs. And remember, one of those pigs was Italy, one of the biggest and most diverse and dynamic economies in the world. And they were treating it like it was a freaking emerging market. Well, yeah, it's run like an emerging market, but it's the Italians. But that's only because of the euro, because the euro is way too strong. Because if the lira came back, the lira would be trading at 45 or 50 cents as opposed to $1.07, which is what the euro is trading at, $1.68 or whatever it's trading at this morning, because of Germany. But Germany's no longer Germany. Germany's deindustrializing. Month over month industrial production came in at a negative 11% in Germany this month. CPI is still running at 7% and 6-7%, and oil prices are going higher. So commodity cost push inflation is coming back, and Lagarde is at negative 3% real yields, and she's going to negative 4. She doesn't raise about 50 basis points next month. Like they're screwed. The bond vigilantes are going to tear these people apart when they finally understand that the Fed is not going to screw them by immediately pivoting the minute they come back into the market. And so once the market gets it through their head that Germany is now a redeveloping market and no longer a first world economy from a credit perspective at 6% Fed funds rate, that's when the German 10-year goes from 2.65% to 6%. Or 7% or 8%, because the American 10-year is going to go to 5% or 5.25%, which is where it belongs. If the yield curve in the United States normalizes, we're going to see, as opposed to 165 basis point inversion of the U.S. German 10-year spread, to 165 point premium and it's going to be immense. And you can't tell me that there aren't guys sitting around Wall Street going, this is the trade of a lifetime. How do I get me some German bunds to short? Like I just don't. The only way Lagarde has been able to keep this afloat is because the vestiges of the central bank, the coordinated central bank policy that was put into effect in September of 2011, are still in place, and there's still pieces of the American government that are still actively supporting what's going on in Europe, meaning at the policy level, at the Biden administration, the U.S. Treasury Department is working for these people. There's other factors. There's a lot of money that they stole over the last decade that's being pushed around various accounts in the Caymans and Isle of Man and the Bahamas and Euroclear and all of this stuff. And that money is all getting drained. Because if it wasn't getting drained, then every time Lagarde intervened in the German 10-year, it would psychologically break the bears on the German bunds by 6 to 8 weeks every time. It's not. The interventions are having less and less effect, just like Mises said it would. So I'm screaming at this. Like, it's so very clear to me. And when that breaks, oh my God, trillions of dollars will leave Europe, fly into the United States, and keep everything afloat for another 12 to 18 or 24 months. Then the bottom starts to drop out of the United States. Then Powell has to pivot and go back to 3.5%, 4%, but not before that. That's what the game is. Can Europe hold it together until they can get rid of Powell and force Powell to pivot before the Bundesbank goes bankrupt and the ECB goes bankrupt, or somebody major breaks away and says, nope, join in the euro? And that's why we then get back into whether or not they're going to start World War III as a cover story for all of this stuff, which is why Ukraine is important, which is why we're seeing what we're seing. All of these things are tied together. You can't talk about the price of oil without talking about everything else I've talked about today. I don't know how to do it otherwise, Antonio. I'd love to, but I can't. And then there's gold and then silver, but it's all about oil at this point because it's all about climate change. And it's all about the price of gasoline, and it's all about inflation and the price of the bond markets. And if we understand that, and we understand these dynamics, and look, I get it. I don't believe that I don't know that I'm right about any of this. And there's a lot of people that I've discussed these things with who are better market veterans than I am, who are like, Yeah, maybe, but the data, and they're looking at things from a different perspective. They look at different data sets, they look at different stuff, and I respect that, like, completely. So I don't know. I put this stuff out there for you to error check versus what you're seeing and hearing from other people, and come to your own conclusions about it. I don't know, but to me, if I'm the player at this table, right? If I'm sitting at this game of diplomacy, and these are the players at the table, and this is an 18xx game. We're playing 1846 race to Midway, right? And we're all trying to run our company better than everybody else and be the guy with the most money at the end of the game. I don't know about you, but if I were Jerome Powell, I'd be taking out Christine Lagarde, and I'd be asking Ueda to give me a hand taking out Lagarde. I don't know. I'm just sitting at this table going, hey, you mind? I'm going to buy you a Coke. We're going to go over to the counter. I'll buy you a Coke. Let's talk about what we're going to do in the next 2 turns. I'll buy you a Coke. Sounds good. Let's do it. And then come back to the table and go, I'm doing this, you're doing that. And then whatever moves we make on the table are the ones that completely screw the other player, and they get wiped out.
Well, he's getting a lot of pressure from China too, though. I mean, they recently lowered the reserve requirements for foreign reserves from 6% to 4%. That was last week, actually. So basically, to me, that's telling me commercial banks selling USTs as China, the largest holder of them.
I don't think China, actually Japan is.
That's right. Yeah, China, Japan, the first and second.
Japan is the largest holder of U.S. Treasuries, by far, and it has been that way, by the way, for 3 years.
Yep.
Even when China was at $1.2 trillion, the Japanese were at 1.3.
But China's still big. They're the second one, I believe.
Yeah, they are. They are the second biggest one. But what's important here is to understand that Powell doesn't care about that. He understands that that's what's happening. He actually wants that to happen. Powell wants to get rid of the burden of the reserve currency. Like, nobody understands this. Like, he's made it abundantly clear. He's like, I think there's room in the world for more than one reserve currency. He said that to Congress. It was like the neocons on Capitol Hill are like, oh my God, get rid of this guy. How are we going to fund our wars? How are we going to subjugate Russia? How are we going to kill the Chinese? De-dollarization is real, but it's not as real as everybody's tried to make it out to be this year. I wrote an article the other day talking about this. Say, look, don't get ahead of yourselves on de-dollarization. Just don't. It's not there. It's happening, but it's not happening at the rate at which you can trade it right now. It's a long-term thing. And if you just want to check out for the next 10 years, fine. Stack sats, stack gold, buy hard assets and that pay dividends, oil majors, and whatnot. As David Hay put it to me over the summer, he's like, the free cash flow yield on most oil majors is in the 14% range. Like, you want a better investment than 3-month treasuries of 5.5%. Well, go just look at the oil major space and go look at most of the industrial metal space at this point. I would say you've got your pick. There's dozens of companies out there producing 9 to 12% payable returns. You go look at a company like Shell that just raised their dividend back to 66 cents a quarter, over 57.5 cents a quarter the previous 3 quarters. They've gone from 25 cents to 66 cents on a quarterly basis since COVID, and the share price has gone from in the 30s to the mid 60s. So you've doubled your money and you've more than doubled your payout rate. And if you bought Shell at the bottom, you're now producing that dividend is effectively like a 35% yield. And you're sitting on 300% gains if you liquidate it. But you're in at $25, getting 60, it's a 12% yield. It's insane. Like, why would you, what I mean? Like, why would you not do this? Right. So, but this is just one. I mean, ExxonMobil, Petrobras, blah, blah. There's so many of them. Like, pick any of them. You'll make money on it. $90 a barrel oil, you're going to make a lot of money. Okay. And just check out for the next 10 years and not care about it. It doesn't matter. Go live your life. Go watch your kids' baseball games. Go write a sonata. Or, I don't know. Do whatever you want to do. It's fine. Or if you wanted to understand what's happening on a turn-by-turn basis, well, that's a different story. The dollar's not done yet. The dollar index is 105. They broke it down to 99 back in July, and then the dollar came roaring right back. Yellen goes to Beijing. They trash the dollar. We're at 105. So we're a quarterly breakout. If it holds 105 through the end of Q3, the technical chart of the dollar turns unbelievably bullish for a run to 130. Okay. And same thing with the euro. The euro closes below 107. Guess what? It's not just going to 90, not going back to the recent low of 96 cents. It's going back to 70. It's going to go to 70 cents because something's going to break. Somebody's going to leave the euro. Right? There's going to be a credit crisis somewhere.
But then what happens to
I
gold?
suggest to you who's got the collateral on one side of the balance sheet and who's got the liquidity on the other side of the balance sheet to deal with the credit crisis that's incipient. The ECB or the Fed. I mean, when I had Danielle DiMartino Booth on my podcast in June, I talked about all these things with her, and she was much more bearish on all of this stuff than I was. I kept bringing these ideas up to her, and she did say, she's like, yes, you're right, that he has the liquidity, but the problems in commercial real estate dwarf that. I'm like, effectively is what she was saying to me, and that's fine. And that's Danielle's perspective, and I don't even disagree with her on that. I actually do agree with her on that. Problem is, I look over there, and I see the size and the unbelievable size of the holes in the balance sheets. Look, when a German auditor comes out and says that the Bundesbank needs a bailout, not Deutsche Bank, but the Bundesbank, like the rock on which the entire ECB's foundation is built, needs a capital injection because it's functionally bankrupt because of the massive losses it has on its balance sheet today, after a year's worth of yield curve control from Christine Lagarde on its sovereign debt balance, right? Because the Bundesbank has basically been the recipient of all the European QE. They're holding Italian BTPs, they're holding Greek bonds, they're holding Spanish bonds, they're holding French bonds, right? That's what they're doing. That's what their target 2 liabilities are. I don't know, dude. I'm looking at this going, if the Bundesbank needs a bailout, who's going to bail out the Bundesbank? It ain't the Fed. I can tell you that.
Well, yeah, that's another topic. Too big to fail versus too big to save. And but we've gone way beyond that line, I think. But what happens to goats and guns in that situation, though? I mean, if the dollar stays strong.
Well, gold you're seeing what's happening to gold in the initial rush, because every time there's an initial rush into the dollar, gold is used as a piggy bank. So are things like silver. So are things like industrial metals, and wherever people can find dollars, right? In that early flush when things start to rise. So, but then the longs all get liquidated and the shorts get over aggressive, and then the market is unbalanced, and then gold spikes on worries of institutional collapse. And so you've got the dollar and you've got institutional collapse, right? Dollar demand is short term. When people need dollars, they can always sell gold and they get dollars, right? It's always used as a piggy bank for that purpose, but it's generally short lived. Look at what happened during 2008. The weekend Bear Stearns vaporizes, gold hits a high of 1033 an ounce, and then collapses that Monday after Bear vaporizes and all of that. There's a massive rush into the dollar. Everybody sells gold. Gold sells off all summer to a low of 681 during Lehman and AIG. Bottoms there. Bernanke announces QE. Gold goes on a 2.5-year run to $1,900 an ounce, only stopped by the announcement of a coordinated central bank slush fund, where policy will be coordinated between the 7 major central banks: the Fed, the Bank of Canada, the Bank of England, ECB, SNB, the BOJ. Did I mention the SNB? 6 or 7 central banks. I can't remember the 7th one. Doesn't matter. The major ones. They all coordinated to make sure that everybody had the liquidity they needed. That broke gold. The institutions came in and said, we're here to do what needs to be done. And the markets were mollified. And that was what broke the gold bull market. Literally that announcement. I was there. I was watching it. I lost my ass that morning. Never forget it, because I was dumb and did not understand what that meant. It's fine. I understand what it means today, because that policy is gone. The Fed's out, BOJ is out, BOE is out, Bank of Canada is out, SMB is out. Who's left? Who's left trying to step on the foot and the brake and the accelerator at the same time? Do QE through yield curve control and raise rates. Last I checked, that would be Christine Lagarde and ECB. So they're the only ones still playing the old game. Everybody else the cartel is broken. Everybody else has gotten out. And now it's just a matter of timing as to when this thing is going to explode. And I'm putting a flag out there of first week in October because of the way markets trade. Just the way the professionals do their job.
What does that mean?
It may not manifest itself into a crisis until Q1, by the way. But we'll see we'll see telltale signs of either what we're seeing will continue and then start to accelerate in Q4, and then it will turn into a crisis in Q1. And if Powell refuses to cut interest rates during any of that, look, the big tell for me for Powell, the big test for Powell was March. 4 major Silicon Valley banks went down, 4 of the biggest bank failures in U.S. history. The bank term funding program was put in place, emergency FDIC measures were put in place, blah, 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 blah. What did Powell do with the very next FOMC meeting? He raised rates. He raised by a quarter point. He said, I am unperturbed. And believe me, that message was gotten by the markets. That was the biggest statement by Powell, that this is not your daddy's Fed. We are not here to make everybody happy. We are here to conduct U.S. monetary policy and what's best for the United States. And what's best for the United States is that we have a recession and a flush of unbelievably overpriced commercial real estate and the political and cultural distortions that engenders. Mazel tov. He can't say that. I can. So I'm saying it. But that's what I think it reverts down to.
Well, what is it? Can you then also tell me what that means for, well, I guess over the short run for commodities, that might mean they keep going up. Your oil, your silver keeps going up, your aluminum keeps going up. But what then? What after?
Well, I mean, look, I don't want to go too far out into the future. Like it's like why worry about this? There's too many variables, Antonio. Let's just deal with the beginning. Yeah, what should happen is the next wave is we'll have a big commodity bull wave. We'll have a big run in the dollar. Money will go to ground, right? Because it'll be a crisis. So what happens during a crisis? Money goes to ground, right? Literally, money goes to ground. The Chinese are not buying U.S. treasuries anymore. They're buying lithium mines.
Oh, they're buying gold too, I think.
And they're buying gold and they're buying all sorts of stuff. They're buying tangible assets. So why wouldn't, right? But I mean, it was literally, it came up this morning, like somebody, like it was a statement like, we're not buying U.S. treasuries anymore. We're buying mines across Africa. And I'm like, yeah, when shit gets real, money goes to ground. Literally, we buy assets in the ground, right? It's why I have people in timberland, for example. It's why I have people in farmland, right? This is, money is going to go to ground. It may not be the sexiest investments. They may not even be very good investments for the next 18 months or 2 years. But the fundamental investment thesis is that if capital is going to flow into real estate, it's not flowing into commercial real estate. Will it flow into farmland? Yeah. Will it flow into timberland? Yeah. Because, carry costs are low and trees grow at 8% a year. And you don't have to harvest them. Nobody's breathing down your neck if you own the property to sell the tree. You can just watch your investment portfolio grow by 8%. If prices stay stable year over year, trees grow 6 to 8% a year. It's a great investment when you really stop to think about it. Timberland is an unbelievably underserved portion of this market. I've been in that But but then you just wait for the timing. When lumber prices spike, then the timber REITs should explode, and you should sell into strength, and reload when the lumber prices crash. But we have a very interesting problem in housing in the United States in the short term, because everybody, as you said earlier, rushed into getting their last teaser rate or their last 3% or 4% mortgage, right? And bid up the price of existing houses. But now existing home sales are falling and new home sales are rising. And there's not enough supply because the home builders can't get the credit to build as many houses. So there's going to be a tight supply there. So new home prices are rising. So only the most qualified buyers are so it's going to be a very interesting problem. The same problem that's happening in the automotive in the auto industry is the same thing. We have used car prices are higher than they should be, and new car prices are still too high, but new car discounts are rising, and used car prices are staying buoyant because there's not enough supply because everything's been screwed up. Fine. But at some point, those supply and demand mismatches will change. The lumber industry will attenuate. And, it'll be the time that people put additions on their house, but they won't build new ones. They'll put mother-in-law suites on their house, but they won't build a new house. They'll take that 3% mortgage that they got 3 years ago, and they'll save up some money, and they'll put a mother-in-law suite in, or they'll finish a garage, or they'll do whatever. It's what I did. It's what my family did in the 70s, so that we had enough room to take care of anybody that got sick, which is exactly what happened. My grandparents got sick, and they had to live with us for a year and a half, and I had to live and I literally lived in the furnished garage, which was my dad's den. He had the big bar and the stereo was in there, but I lived in that room for like 2 years as a kid.
Lumber prices haven't really gone anywhere, by the way, for the last 25 years, besides, the spikiness over the last couple of years. But, inflation adjusted, they've actually gone down.
Mm-hmm.
So
but timber REITs but timberland has done very well, because the way timber REITs operate is that the smart ones buy timberland near the urban frontier. And then as the urban frontier expands towards that land, the land improves in price. They sell the timber, and then they sell the land, and then they use the proceeds from both. They sell the timber to pay dividends to the REIT investors, and then they take the money, they take the profit from the land that appreciated in value 3 times, and then they go to the new urban frontier and they buy there. That's what they do. Pope Resources used to do this before they were bought by Rainier. Rainier does it all over the southeastern United States. So you just have to understand the market and how it works. And it's the same thing with grain prices. And, but these things are still going to look, it's still going to be it's not going to be it's not a sexy investment, but it's unlike miners, where it's expensive to build a mine. Mines come with cost overheads of anywhere from $80 to $250 million. That's got to be financed by somebody, even if you do it on good terms with, a partner like Franco-Nevada or Royal Gold or one of these royalty companies that comes in early, becomes a partner, as opposed to an extractive partner like a bank with a non-recourse loan, and where they immediately go short against you and in order to hedge the extractive venture capital model. In timber, you don't have to harvest your freaking land. You don't have to top grade when prices are down. You don't have to do anything. You just wait and let the trees grow. And then you harvest more board feet the next year. Like
simpler. Sounds a little bit simpler than geophysics and geochemical anomalies and all that type of thing.
The problem is that most of the investment opportunities in timber are private. They don't go public. There's just not a lot of good ones, but they're there. They're there. There's a few, but they're there. But there's a lot of good investments. And when you actually normalize the NCREIF timberland index for, going back to like 1987, it's comparable to the S&P 500 in terms of value. I've done the analysis multiple times, and it'll probably improve. It got suppressed during the ZERP and NERP years, but you wait it'll explode during high interest rates. So there's a very good opportunity. I think the entire sector is down. The whole REIT sector is down because everybody's expecting a crash in real estate, but they've thrown the baby out with the bathwater. And there's certain sectors in real estate that are going to do very, very well. Commercial real estate's not one of
them. Right. And then you also I wrote a tweet and I asked, with uranium now over $60 a pound, what metal is today where uranium was in early 2020, which is, it was $20 a pound back then. And you said aluminum.
Yep. That's
interesting. I mean, is that the whole thing of shutting down the smelters and it takes too long to start them up and all that?
Oh yeah, that's part of it. Aluminum is congealed electricity, and electricity prices are not going down. Not if they keep not there's a war on stable electricity prices in Europe and the United States, because wind and solar as your base load as opposed to nuclear and oil. Remember, the Germans are they're beginning to knock down their wind farms, thankfully, and replace them with coal power plants because there's still coal in the Sudetenland, right? But that's going to take time.
Okay.
Aluminum's going to be in very short supply, and they just think that I've been bullish on aluminum for a while. It's just the entire industrial metal sector right now is in the dirt because everybody's expecting a recession. So they're thinking in terms of that. They're not thinking in terms of cost push. They're thinking in terms of, and that may be the case. And it may take another 12 to 18 months for that to happen. I don't think so. I think we're going to see oil break out first, and then everything else break out after that, because the short term, it will be a pressure. High oil prices will be a pressure on COGS, cost of goods sold, right? For all the miners, because energy is their highest. Energy and labor are the 80% of their friggin' costs, right?
Of course, yeah.
Or more. And but at the same time, that just means that they're going to have to demand higher prices, and they'll cut back on production. Supply will, and then prices will rise, and then the commodity markets are always out of phase with everything, because they're so tied to the cost plus model. And the cure for high energy prices is high energy prices. The cure for low energy prices is low energy prices, or commodity prices in general, right? So if aluminum is low, and it has been, it went through a massive pump and dump, but it also went through a pump and dump back to a roughly where the floor used to be, similar to copper, for example. Copper, the floor, the ceiling used to be $4. Now the floor is $3.75. I don't see copper going back to $2 a pound.
No.
Do you? Okay.
That makes no sense.
Do you see natural gas? And it's the same. And so it's the same thing with aluminum, lead, nickel, lithium. I don't need anything sexy. Aluminum is, you can't run a modern economy without aluminum. And yet we're not just shutting down smelters, we're shutting down whole companies. And that means a massive startup cost of capital at, there's going to be, scrap aluminum prices are going to rise, and, recycling will rise. Sure. And all of that stuff. We'll start mining the friggin' landfills eventually we're going to be mining landfills for aluminum within 5 years.
And the moon.
Well, everything, what bothers me is that people, like the environmentalists, get really angry and they get all aggro. Oh, landfills are terrible and blah, blah. Like, no, they're not. They're new mines of stuff that we threw away, and we're just it's just sitting there for a while, and just catch the runoff and treat it, and okay, fine. But these are new mines just waiting to be there's all sorts of good stuff in there. Let it go. And then there's all sorts of great technology to turn garbage into, usable products that we're not even allowed to talk about. We're not even allowed to invest in, because God's forbid, I don't even want to go there. It's just so insanely frustrating. I used to talk to a guy that used to be a customer of mine at the farmer's market. We used to talk about this stuff, and he couldn't pay Waste Management for their garbage so that he could test so that he could get a stable supply, so that he could make a product. so they could, burn garbage and, make cleaning products from it, make ammonia and chlorine dioxide and stuff. Waste Management wouldn't sell him the garbage because it was against regulation. It was against cleanliness regulation. There's some stupid EPA regulations. Clearly, these are just regulations that are put in place to freeze commerce and to force investment capital into areas where the government wants it to flow. Again, back to the original points in the conversation about we don't have capital markets. We have directed markets. And we have to get back. And the way you get back to capital markets is getting away from, fake interest rates and fake money. Reality is, it's just all you have to do is reassert reality, and all of a sudden everything, everybody starts acting a lot more rationally. They may hate it, but they start acting rationally. It's like telling your dog, nope, you're not in charge. You put your hand on his chest and you wait for him to stop struggling until he gives up. And then you praise him for submitting, because he's supposed to submit because he's in your world, not theirs. He's out in the wild. Be a dog. When you're my house, I'm in charge. Well, it's the same kind of thing here with bad ideas. And this is what the communists that we're dealing with are going to have to learn. Communism is a bad idea. It always has been. No, really, it's a bad idea. And we're going to make it die a painful death. And we're going to do so at 7%. So you want Powell to go to 7%. It's just going to suck. But it'll suck in the short term for a much bigger long-term benefit, which is we won't have the political and financial dissolution of the United States, the only country on the planet where the government is, by law, subservient to the people.
And that's making, I guess, the long-term issue of commodity shortages, it's actually making it worse, because we need incentives. We need less red tape. We need government stimuli into the right spots to increase productivity within the commodity space, which is not happening.
I don't think so. I think we need to get the hell out of their way. I think every one of those markets is completely overregulated to the point by the EPA, by the DOE, by this one, by the Bureau of Land Management and everything else, in order to stop development, in order to stop extraction, in order to maintain certain cost structures. I think it's been that way for years.
Yeah.
And it's get out of these people's way, let them operate. I saw something this morning. Somebody sent me the EPA is suing Berkey water filters because the Berkey water filters is suing the EPA because Berkey water filters has now been by diktat designated a pesticide by the EPA. And they need to be regulated as a pesticide. It's purely just designed to ensure that we don't have access to nice things.
Yeah.
They want us sick. They want us dying. It's like they want to exert control at every level, and they want to bankrupt things that make our lives better.
Yeah. Too much regulation is almost always the problem. I was watching a documentary about student housing in the Netherlands, where they have some type of a point system that the government has set up that basically dictates the rent that you're allowed to charge per room, which is of course silly. So what did the free market do, which at first was the black market, because the black market is the free market. But so what did the black market do at first and then turned into a free market is that they started renting out full apartments as a one thing instead of different rooms by themselves. And so now the government's catching up to that, and they want to go ahead and regulate that as well, to the point where nobody's going to want to put up their house or their apartment up for rent as student housing, because they're going to be losing money on it. Right. And so the government is then going to start complaining about, these greedy landlords, we don't have, prices are too high, we need to bring them down. What do we do? And so, yeah.
They never go back and go, maybe that was a bad idea in the first place. No, our ideas are always good. You ants refuse to do what we tell you to do.
Yeah.
Do what we tell you to do. No, screw you. We don't want to do this. And they just, the authoritarian mindset, Antonio, is just, they don't get it, and they won't get it until, and they don't even get it when they're on their way to the freaking guillotine. They just won't get it until they're removed from the scene. They just don't understand. They just their faith in humanity is so low. They look at this. They look at these situations and they say, "Look, I can't see a solution to this problem. Therefore, one does not exist." Oh, I give you a solution that you didn't think of. I don't think that'll work. Therefore, like, who the fuck are you to tell me that won't work? Why don't you get out of the way and let people decide for themselves what works and what doesn't work? That's all you got to do. Oh, we can't have that. Well, why? Because then you might be wrong. Everybody might wake up and realize we don't need you. Perish the freaking thought. I'm getting the fucking vapors over here. It's like ridiculous. I'm starting to curse a lot now, so you might want to cut this off because I'm like getting a little tired. So, but you're absolutely right that it's madness. It's just madness.
Well, but it's bad. But you could take some of these stuff into your hands and trying to profit from that by realizing that we are going into a commodity cycle here because of years of overregulation and underinvestment in these spots. And so that's what we've been talking about, right? I mean, it was hidden gems throughout the conversation. It was a broad conversation about, the broad markets, but global macro, geopolitics. But, you mentioned oil, you mentioned gold, you mentioned, we talked a little bit about uranium, I guess, timber, aluminum, all these things, over-regulations, underinvestment. And on a long enough time frame, they work.
Yeah, they don't. Well, in a long enough time frame, you'll make it back. You just have to be careful of, understanding the timing. Like, it's just simply put, going through the motions of, and going through the exercise of trying to understand what's happening. Gives you the opportunity of even if you don't want to swing trade this stuff or you don't want to get like any of that stuff, you can at least identify, what's undervalued and what's not. It's not hard. And then, look, and that's why I teach my people how to read charts. It's why I constantly try to reinforce this stuff with simple technical analysis so they can read a chart, understand how, what a bottoming pattern looks like, what breakout looks like, how to assess markets through time so that you can see, so you can not be gaslit by the headline of the day versus how the market reacted to it versus whether or not it's a structural trend change, if it's or not. And like, these are really important concepts that empower people, investors, to make good decisions with their money. Even if they don't have the time or the skill or whatever to manage their own portfolio, to be able to sit down, have an intelligent conversation with their portfolio manager or with their accountant or whomever and go, okay, this is what I see is happening. How do we proceed? And then you go find me stocks that fit this thesis.
Right.
I don't have time to fit that. That's what we're doing. That's our job here, folks. I can't tell you how to trade the markets. I can only help you. And never would I want to. I give you ideas. I give you examples of companies in markets that I think are good. That doesn't mean it's the only one. It's not like I've done an exhaustive search like these guys on Seeking Alpha that go through 35 friggin' REITs and decide which two are good and the other 33 are bad, or relatively speaking. That's not my gig. My gig is to say, you might want to look at the timber. There's 3 or 4 opportunities out there. Here's the one I kind of like. And it's trading at a good price, so it's not a bad value. I make it abundantly clear to people that the portfolio in our newsletter is an example of stocks within these markets that I really like, as opposed to the definitive stock in that market, right? Because if I spend all my time assessing the balance sheets of companies, I can't keep my eye on the prize of what's going into the future. And honestly, the macro thesis is far more powerful than the sum of parts or balance sheet analysis of, Shell versus ExxonMobil versus Chevron, right? I don't know. Pick one. You should be able to. Balance sheet analysis is cheap and easy out there, folks. It's not hard. And the market will generally tell you what it thinks of the balance sheet of those 3 companies anyway. So look at the chart, look at the weekly, monthly, and quarterly chart. You'll probably get a good enough picture of what the market thinks of the differences between those 3 companies and the basic metrics of those three companies. And you'll be able to pick one and go, yeah, that one looks good. And then you can drill in and go, oh yeah, it's got that project there and that thing. And that, and then you tell the story. But like, it doesn't have to be, because like I got news for you. Like no one reads the $2,000 JP Morgan, notes that the investment notes that these guys put out, the sum of parts analyses that these guys put out. No one reads them. They don't. Or if they do read them, they only get them because they get them gratis with their Bloomberg terminal or with their their Morgan Plus account or whatever the hell it is. They've got enough money that they just get that stuff for free. But no one's buying those $800 things that they're not buying that stuff. Who would buy that crap? I've read them. I read all those reports. I used to work with a broker who had access to Thomson Reuters. I used to get that stuff all the time, and I'm like, maybe there's some value in there. I don't know. They charged $800 for that shit. I could have written it. I couldn't have written it because I can't do a discounted cash flow analysis. I don't have an MBA, but like I can pay a guy with an MBA to do that. And like, oh, yeah, no, those numbers are crap.
What's your offering right now? You've got your Patreon. How much is that?
The high end on the Patreon is $12. It's for everything. It's for the newsletter, which we put out monthly, which has a portfolio in it and all original material. And then there's the $4 tier, which has everything else other than the newsletter, which has the private blog posts and the private market reports, which are basically 45-minute podcasts and analysis of important markets, and that's it.
Right.
That's what we do.
And that's on Patreon. Gold, Goats, and Guns. Yep.
Patreon/Gold, Goats, and Guns, or you can go over to the blog at tomluongo.me, or you can follow me on Twitter, and eventually you'll find a path in there on TFL1728 on Twitter or X.
I'll put it up on the screen for people interested. Check it out.
Appreciate it.
Tom, this has been amazing. Thank you so much for investing so much time in me. I'm looking forward to our next discussion.
Absolutely. Thank you, Antonio. It was a pleasure, as always.